Hi. Hi. There are certain words which confuse us if you are a student starting with accounting. I started my accounting studies after completing my graduation in physics. So I was a lot of confused with some of these words which were commonly used in English literature, but for accountant, it is some slightly different. So let us see what is the main problem with these words for a beginner in learning accounting. Let's start with the first one. We have 17 such combinations. The first one is business versus services. The problem is that we don't know whether business and services are same or not. Business services, business is the universal set, the bigger term, and the services is a subset in it. That is, business includes services. Then what are the other subsets? Manufacturing, trading. So now we have three words: manufacturing, trading, services. So are they same? Yes, they all are businesses. But what is the difference? These manufacturers and the traders, they deal with the goods. But services, there is no goods. That is the difference. For example, a doctor providing services to patients. There is no goods. He is collecting fees, so it's a business. But there is no goods involved in it. But a shop owner sells tea packets. So there is a goods, tea packet is there. So that is the difference. He is a trader. And what is who is a manufacturer? A manufacturer is a person who purchases raw materials. Then he uses his machinery and he converts that raw material into finished goods. Then what he is selling is finished goods, not raw materials. So his stock includes raw materials and finished goods. But for a trader, there is no raw materials. He purchases the finished goods and he sells the finished goods. So this is business. So there are three words: manufacturing, trading, and services. Now let us move to the next word, that is goods and assets. In common parlance, goods and assets, they are same, they are one and same. But for an accountant, they are different. What is the difference? If you look into the balance sheet, you can see that goods are there in the asset side. Stock in trade is goods. They are goods. So goods are there, then goods are assets. Then what is the problem with goods and assets? So my problem was, sometimes I see that goods in asset column. Sometimes they are not treating like that. When there is a transaction of goods and when there is a transaction of an asset like a building or furniture, they are treating it differently. A transaction goods, buying and selling. See, this buying and selling, we use it for assets also, but accountants, it is different. Buying and selling, when they say that they purchase, they mean that they are purchasing goods. When they say that they are sales, that they are talking about sale of goods. But when they sell assets, they credit the asset account. And when they purchase assets, they debit the asset account. And that is the difference. Next item is purchases and sales. So purchase of fixed asset is not treated in the same way as purchase of goods. Purchase of goods, we put it in purchase account. But purchase of fixed assets, we are not putting it in, we are not include it in purchase account. We record it in that fixed asset account. And purchases, you know that there are two persons, one is a buyer and other one is a seller. And the seller is a person who is selling goods, and the buyer is a person who is buying goods. And when a seller sells goods, he credits the sales account, not the goods account. So that is the difference in treatment of purchases and the sales. And in the seller's book, it is treated as sales account, and the purchases or the buyer's book, it is treated as purchases account. So if he is purchasing only from one person and that person is selling only to this person, his purchase account and this person's sales account will be same. It is accounting. In accounting, we are doing like that. Now, stock versus assets. So in balance sheet, we know that there is one side, there is liabilities, and the other side, there are assets. Stock is also there. Stock is one of the assets. Then how this stock is different from other assets? And what is stock? So we think that when we purchase furniture and sell furniture, then some furniture is there remaining, that is stock. No, that is not stock. That is fixed asset. Stock is goods. They are talking about goods. Goods can be raw materials, it can be finished goods or work in progress, if it is in between. But when we say stock, it is only about goods, not about the assets, not about the fixed assets. They are only goods. Even current assets, no. Stock is a current asset, but cash in hand is a current asset. But that is not stock. Stock means stock of goods. So for a manufacturer, the stock is 3 items: raw materials, work in progress, and finished goods. But for a trader, this raw material and work in progress is not there, because he is dealing only with the finished goods. So for him, there are only finished goods, that is stock. The next is assets and liabilities. So in asset side, you can see that the items like building, land, furniture, cash, stock, all these items are there. And liability side, you can see the bank overdraft or a term loan from the bank or creditors. And the asset side, debtors is also there. And what is the difference between these assets and liabilities? For a businessman, it is very important to know the difference between assets and liabilities. You know that the balance sheet, the total is same. Then what is the difference? Assets are properties of the business. They will bring cash in the future. But liabilities, they are going to take away your cash. For example, if there is a bank loan and you have a cash, the bank will take away your cash in future. Even though you are holding that cash for some time, bank is the real owner of that cash. They will take it away from you. So that is the difference, because the business owes the banker that much money. Now he has to pay it back. So what is Therefore, the business money is only what is remaining after paying the bank. And that is called equity. His equity in the business. Now, debtors and creditors. If somebody is going to give him money in future, he is called a debtor. And if for someone I have to pay money in future, then that person is a creditor. That is the normal thinking. But in accounting, it is not like that. There is a slight difference. Understand the difference. These words, debtors and creditors, are used only for your suppliers of goods and the customers. Suppliers of goods from whom we are purchasing goods, and the customers who are buying goods from us. Buying goods from us. They are called debtors because we have made a credit sale. Now we have to collect money from them. So they are debtors. And these creditors, we have got a credit purchase from them. Now we have to pay money to them because it's a credit purchase, not a cash purchase. Cash was not paid at the time of purchase. So that person is a creditor. Suppose I purchased a furniture to use it in the business, not for sale, and I have not paid the money, then that person is not a creditor because it is not goods, it is assets. It is an asset. So these words, debtors and creditors, are used only when we sell goods and purchase goods. The next word is capital and drawings. So when in the examination problem, you can see that there is capital introduced and withdrawn. Then what is this drawings? Drawings is money taken away by the owner. That is drawings. In the proprietary concern, the drawings is the money taken away for his personal use, or goods taken away for his personal use. That is also drawings. So capital is something that owner brings into the business, and drawings is he is taking it away from the business. So in accounting, the owner and business are different persons. So we have to record the transactions between the owner and the business. Separate legal entity concept. So that is capital and drawings. They are transactions with the owner of the business. Then profits and income are the same? No, they are different. Profits is different from income. Income is revenue. That is the gross amount. And profit is income minus expenses. That is revenue minus expenses. So they are not same. It is income is before deducting the expenses, the gross amount. So don't confuse it with income tax. We are talking about accounting. It is the profit is the difference between income and expenses. Here income means revenue. Now, losses and expenses. So what is loss? Loss is that we have incurred a cost, and the benefit is we have not received the benefit, and it is not going to be received in the future also. For example, goods lost in fire. So we have incurred a cost while purchasing the goods, and we may get a profit at the time of selling it, but the goods are not there for sale. They are lost in fire. That is a loss. The benefit is not going to be received. But expense is different. Expense we know that the benefit, even though it is not received right now, it will be received in the future. That is an expense. So expense is something we will get the benefit during the accounting period. But losses are not like that. We won't get any benefit from it. So expenses are connected with the revenue or the revenue for the accounting period. But losses, there is no connection. There is no connection. Now, deposits and overdraft. These are bank account. So you can see that if you go to the bank, they and deposit money. Suppose I deposit 10,000 rupees in the bank, then I draw a check of 10,000. The bank will accept it. But if I draw a check of 25,000, then what will happen? The check will be bounced. The bank is not going to pay 25,000 because I have deposited only 10,000 rupees. But if there is an overdraft facility, the bank will accept that check and pay 25,000 on the condition that I have to pay 15,000 after some time. So this is an overdraft facility. So we can withdraw more money than we've deposited from the bank. The bank will, of course, the bank will charge interest for that. But you can withdraw more money. But the bank will put a ceiling also. So you cannot withdraw all the money from the bank. They will put a ceiling based on your credit worthiness. And that is an overdraft account. Now, deposit is an asset and the overdraft is a liability. Equity and working capital. What is the difference? Equity and working capital. And what is this working capital? Is it capital? No. Working capital is the difference between current assets and current liabilities. Equity is the difference between assets and liabilities. So if you reduce assets and liabilities, they are equal. By liabilities, I mean outsiders liabilities. So if you deduct outsiders liability from the assets, what is remaining is for the owner, and that is his equity. But working capital is different. Working capital is the difference between current assets and the current liabilities. What are current assets? Assets which can be converted to cash during the accounting period. For example, stock or debtors. Now, current liabilities, we have to pay that liability within one accounting period. So they are current liabilities. Now, the difference between these current assets and current liabilities shows the strength of the organization to pay the money. For example, if the difference is more, that means that the organization has enough money to pay and it has no short-term problems. But if the difference is slow, narrow or negative, that means that there is a liquidity problem for the organization. So the working capital is the difference between current assets and current liabilities, and equity is the difference between assets and liabilities. Liabilities excluding that capital and profit. Now, what is the connection between this depreciation and fixed assets? You can see what are the fixed assets. Fixed assets are land, furniture, equipment, buildings, factories. All these are fixed assets because we use them to earn money, to earn profit. Now, what is the connection between depreciation? Depreciation is not for current assets. Depreciation is only for fixed assets. Depreciation is the decrease in value. The decrease in value of an asset, of a fixed asset. And that is depreciation. So we charge it every year to the profit and loss account to match the revenue with the expenses, matching concept. Now, Whether depreciation is there for all assets? No. For land, there is no depreciation. Land is a non-depreciable asset. It is a fixed asset, but it is a non-depreciable asset. Now, current assets versus fixed assets. Current assets, what are current assets? Current assets are inventories, debtors, investments, bank balance, cash balance. All these are current assets. Fixed assets, we have already seen: land, building, furniture, equipments, computer. Fixed assets, we use these fixed assets in the business. But current assets, they are marketable, or they can be converted into cash very soon. You see that if the debtor is there and I telephone him, hello, you have not made my money. Okay, I will pay it today. Now, the money is there in the bank. But for furniture, I cannot say that. But for debtor, I can say that. I can, if the money is there in the bank, then I can convert it into cash very easily. If it is a stock, then I can sell that stock and collect money from the buyer. It can be converted into cash very quickly. So current assets are such assets. But fixed assets, we can sell fixed assets, but then the business will be disrupted. Now, disclosure versus accounting. In your examination, there's a statement that all assumptions are to be noted in the answer sheet. It's a disclosure requirement. What is the difference between this disclosure and accounting? Accounting is writing journal entries, and disclosure is a statement. You're just making a statement about a transaction. You have an assumption and you made it as a statement. There is no journal entry. There is no journal entry. But in accounting, every transaction, there is a corresponding journal entry. We debit one account and credit another account, and that is journal entry. But in disclosure, there is no journal entry, and that is the difference. And disclosure requirements are also there. When learning accounting, when they say about disclosure, disclose this, disclose that, that means you don't have to pass a journal entry. You cannot pass. But you have to make it as a statement, as a note to the financial statements. Now, inventory versus raw materials. Raw materials are only for manufacturers, not for traders and service providers. Raw materials, we are not selling raw materials, we are converting raw materials into finished goods. Raw materials are the part of closing stock of a manufacturer. So that is the difference. Now, liquidity versus solvency. Liquidity is about the repayment capacity of short-term liabilities. And solvency is your repayment capacity about long-term liabilities. So if you have the capacity to pay short-term liabilities, but you do not have that much assets to pay the long-term liabilities, that means your liquidity is safe, but you have solvency problem. Or if you have enough assets to repay your debts, but you don't have enough cash with you to pay your current bills, then you have a liquidity problem, not a solvency problem. You are not insolvent, but you have a liquidity problem. You have a cash crisis. Now, the next is profit and notional profit. This is the last one. Profit means realized profit. We can record only realized profit in accounting. Notional profit is, you cannot record it, but the profit is there. For example, I purchased 10 kilogram of sugar and I sold 7 kilogram of sugar. Now the 3 kilogram of sugar is with me as a stock in the stock. Now suppose the price of sugar is increasing. I purchased it for 50 rupees. Now the price is 70 rupees. So I have a profit of 20 rupees there in the stock. That 20 into 3, 60 rupees is a notional profit. When I sell that 3 kilograms, it becomes a real profit. So before selling, it is a notional profit. And in accounting, these notional profits are not accounted. You can account it only the real profits. So that is about the confusing commercial terms. I think that this session will help you to learn accounting in a faster way.